Welcome to Business with Louis, the show where we break down complex business concepts into actionable advice for entrepreneurs and business students. Today, we're going to explore working capital management, a vital aspect of running a successful business. So, what is working capital management? In simple terms, it's the process of managing your company's short-term assets and liabilities to ensure you have enough cash on hand to meet your financial obligations. This includes managing accounts receivable, inventory, accounts payable, and cash reserves. Effective working capital management is crucial because it helps businesses avoid liquidity crises, reduce debt, and increase profitability. The concept of working capital management has been around for centuries, but its importance has grown significantly in recent years due to the increasing complexity of global supply chains and the need for businesses to be more agile and responsive to changing market conditions. Influential thinkers like Peter Drucker and Michael Porter have written extensively on the topic, highlighting the importance of managing working capital to achieve competitive advantage. At its core, working capital management is about finding a balance between liquidity and profitability. On one hand, you need to have enough cash on hand to meet your short-term obligations, such as paying suppliers and employees. On the other hand, excessive cash reserves can mean missed opportunities for growth and investment. The key principles of working capital management include cash flow forecasting, inventory management, accounts receivable and payable management, and financing options. Let's take a look at some real-world examples to illustrate how working capital management plays out in practice. Companies like Walmart and Amazon have optimized their supply chains to minimize inventory levels and maximize cash flow. They use techniques like just-in-time inventory management and vendor-managed inventory to reduce their working capital requirements. On the other hand, companies like Tesla and SpaceX have faced significant challenges due to poor working capital management, including liquidity crises and delayed payments to suppliers. Another notable example is the company Dell. In the 1990s, Dell revolutionized the computer industry by introducing a direct-to-consumer sales model that allowed customers to customize their computers online. However, this model also created significant working capital challenges, as Dell had to manage a large inventory of components and finished goods. To address these challenges, Dell implemented a just-in-time inventory management system that allowed it to reduce its inventory levels and free up cash for other uses. In addition to these examples, research findings have consistently shown that companies that manage their working capital effectively tend to outperform those that do not. A study by the National Bureau of Economic Research found that companies that optimize their working capital management tend to have higher profitability and lower risk of bankruptcy. Another study by the Harvard Business Review found that companies that reduce their working capital requirements through efficient inventory management and accounts receivable collection can increase their return on equity by up to 20%. So, how can you apply working capital management in your own business or career? First, it's essential to understand your company's cash flow cycle and identify areas where you can optimize your working capital. This might involve implementing more efficient inventory management systems, negotiating better payment terms with suppliers, or improving your accounts receivable collection processes. Another critical aspect is cash flow forecasting, which helps you anticipate and prepare for potential funding gaps. By using tools like financial modeling software or consulting with a financial advisor, you can create a robust forecast that informs your working capital decisions. For instance, companies like Starbucks and McDonald's use cash flow forecasting to anticipate seasonal fluctuations in demand and adjust their inventory levels accordingly. It's also crucial to maintain a healthy balance between liquidity and profitability. While it's essential to have sufficient working capital to meet short-term obligations, excessive cash reserves can also mean missed opportunities for growth and investment. My experience with market cycles has taught me that finding this balance is an ongoing process that requires continuous monitoring and adjustment. In addition to these strategies, companies can also use various financing options to manage their working capital. For example, invoice financing and supply chain financing can provide businesses with the necessary funds to meet their short-term obligations while they wait for payments from customers. Companies like PayPal and Square have made it easier for small businesses to access these types of financing, helping them to level the playing field with larger competitors. To further illustrate the importance of working capital management, let's consider some additional business concepts that are closely related. For example, accounts receivable factoring can provide companies with immediate access to cash by selling their outstanding invoices to a third-party factor. This can be particularly useful for businesses with long payment terms or uncertain cash flows. Another related concept is inventory turnover, which measures how quickly a company sells and replaces its inventory. A high inventory turnover ratio indicates that a company is selling its inventory quickly and efficiently, which can help reduce working capital requirements. On the other hand, a low inventory turnover ratio may indicate that a company is holding too much inventory, which can tie up cash and increase working capital needs. In conclusion, working capital management is a vital aspect of running a successful business, and understanding its principles and practices can make all the difference between success and failure. By applying the insights and strategies we've discussed today, you can optimize your company's working capital, reduce debt, and increase profitability. If you have any questions or topics you'd like to discuss, please don't hesitate to reach out, like, share, and subscribe, and remember, every great business starts with action. Make your next move count.